Welcome back. You're watching Markets at Noon on ET Now. Let's address some earnings then. Equitas Small Finance Bank delivered its fourth quarter numbers and it's been a great set. We have the net profit that jumped more than 2.5 times. The provisions as well in the quarter gone by have been lower, which has further aided the bottom line. Advances as well have grown in double digits. It's the asset quality, however, that has deteriorated a tad bit. So let's introduce on the show Mr. N Vasudevan, the MD and CEO of the company. Hi, Mr. Vasudevan, good afternoon. So, yeah, to start with, despite, it being a tough environment, you put forward quite a good performance, especially on the profit front. Your gross NPA ratio has been lower than the pro forma NGNPA of the last quarter. So, if you could round up what exactly has led to this performance?
We had a reasonably good quarter, I would say, under the circumstance. The fourth quarter was reasonably good. We saw a very strong comeback on the collections front. The December month was the first indicator that things could come back to normalcy. And the fourth quarter really came back quite sharply. I would say March was probably one of our best months, both in terms of collection as well as in terms of disbursement. In collections, if I have to just kind of say that the X bucket, what we call as the X bucket, which is customers who don't have an overdue, how many of them are able to pay up their EMIs in the next month? So pre-COVID, that used to be about 99.2%. And in the month of December, it came to the 99% level. And by March, it had come back to the full pre-COVID level of 99.2. So what that really signifies is that, there's no fresh stress building in the book. That, I think, is the first important indicator that the book is kind of coming back to shape. And subsequent to that, if you look at the overdues and then the NPA, there has been a good level of progress, I should say. Our GNPA has come down from 4.2. 4.2 in December was our pro forma NPA. From that, it has come down to about 3.6% by March. The provision coverage ratio, last year we had started at 45% and then we ended the year at about 58%. So we have been able to increase the provisions because somewhere in December we had actually changed the provisioning norms for the bank and increased provisioning at various stages of NPA in terms of various asset classes. And so our provision coverage has actually gone up from 45 to 58% by end of the year. So I think overall it's been a decent year that's gone by.
Okay, Mr. Vasudevan, you spoke briefly about the gross NPA. So let's talk about that because I think it's fairly encouraging for the street to see that the GNPA ratio has come in lower than the pro forma GNPA, and you have increased the provision cover as well. But with the kind of severity that we are seeing the second COVID wave come in, do you see the possibility of there being higher NPAs going forward and thus the need to make higher provisions?
Yeah, so I think that the jury is still out on that. I don't think any of us have an answer to that question right now. So I think we are all really hoping and praying that the various government initiatives that's being rolled out are rolled out in an effective manner, and somewhere down the line we just get our life back to some level of normalcy. I think that's a hope that all of us are actually living by, and so we should. April has been severely impacted and May looks like it will definitely be impacted again. June we'll have to see, and then the second quarter is where a lot of hope is being pinned. So I think we have to just wait and watch how things go. But in terms of our preparedness to meet this kind of a situation which might arise, we have just gone through a full year of stress because of COVID, and I think we have come out pretty well. Our customer segment has proved to be quite resilient. We started with the 98% of our borrowers going to moratorium in the first moratorium of last year, 98%. And from there, we have come to an X bucket, which is 99.2% of the customers paying up on the X bucket, format. So I think our customers have shown a lot of resilience, and I think that's our biggest strength of Equitas Bank. I think it's a resilience of our customer segment. I think that's what we are really pinning a lot of hope and comfort on. And so we'll have to just wait and watch how things move. But we are fairly confident that once things come back to normal, our customers will come back to normalcy quite fast.
Good afternoon, Mr. Vasudevan. This is Cheryl also joining in. You just mentioned that a majority of your customers did opt for moratorium last time. In the first wave, we also saw support coming in from government as well as RBI to support the economy via various measures. But as an industry player, do you feel that there is a need for certain supportive measures from government as well as RBI this time around in the second wave, given the uncertainty around it?
Yeah, so clearly the customers' cash flows are beginning to get impacted. In the first 2 weeks of April, it was not really bad because life was still, in a way, possible. But if you see, Karnataka has gone into a full lockdown, Maharashtra has gone into a full lockdown, UP has gone into a full lockdown, and other states have got some kind of restricted, environments. So in the last 2 weeks, I think clearly customers' cash flows are getting impacted. 2 week is not a major issue. People can come back and be normal after that. But the point is that it's not likely to end at the end of 2 weeks. Might extend beyond that. So the cash flows, when customers' cash flows are impacted, and these are people who do daily business and their daily income runs their families and helps them manage their cash flows. So when the business is not possible to carry on, definitely they will come under cash flow stress and they will need some kind of support. So we have to just wait and watch. I mean, RBI has been in touch with a lot of banks trying to get ground level feedback from the market. And we have also been giving those feedbacks. So I think something might come along. We really have no idea what shape or size it will come. But I think some kind of a support should come to help these people tide over. I don't know, maybe 2 months, maybe 3 months kind of stress is probably what they may have to be helped to tide over.
All right, point taken. Mr. Vasudevan, let's talk about disbursements. They have seen good growth. What are the trends that you're actually seeing across the segments now?
Yes, see the segment that we operate in, they are all, mostly they are very highly underserved segments, underserved by the banks. And because of that, there's always a large amount of unmet demand, which is there in the, for credit, unmet credit demand in these segments. So if you take the small business loan, if you take the used commercial vehicle, there's hardly any banks, and I don't think any bank at all are present in those segments. And that just means that there's a lot of demand which has not really been serviced by the banks in all these years. So that's why if you see our March disbursement was very strong. I think March was one of our highest in terms of disbursements for the month. So when things come back to normal, the credit growth is generally not really an area of concern or a worry for someone like us. We can quickly get back and have a good credit growth whenever situation improves, and the demand continues to remain very robust. So first quarter, I don't think it's going to be a great great quarter in terms of disbursement. But if things do settle down sometime by June, maybe, hopefully, and from July or August, if things come back to normalcy, I think we should see a reasonable, good credit growth recovery for someone like us.
Okay, Mr. Vasudevan, let's talk about the deposit momentum because it's been pretty strong. Your deposit book is at a little under 16,400 crores. Now you mentioned, the cash flows of customers are getting impacted. So, how long will that, do you think, what's the outlook on deposit mobilization? What's the share of retail deposits? And how long will this 7% rate on savings deposits continue?
Yes, so deposits have done really well last year. I mean, most of the year people were sitting at home, but still we did a great job. I think that's largely because our digital initiatives got going very strongly during the last year. And, we have opened up our selfie savings account. People can open savings account in a matter of maybe 4 to 5 minutes. And so the number of accounts, if you see, the previous year, we had opened 1.6 lakh savings accounts. Last year, we actually opened 4.7 lakh savings accounts, almost 300% jump in the number of accounts opened last year compared to the previous year. And that's a very large signal significant increase in the number of accounts, and that's what is really fueling the growth in the deposit base. And our CASA, if you see, also has gone more than 200% during last year, and we starting with a 20% CASA ratio. We entered the year with about 34% CASA ratio. So I think our CASA and overall deposits has been doing well. Our retail to wholesale deposit also has done quite well. Our retail is now 72% of our total deposits, which used to be about 50% a year back. So retail has really got up strongly over the last year. I think a lot of multiple efforts, multiple programs that's been rolled out, products which has been rolled out. I think a combination of all of that combined with the digital channel and the digital outreach, I think that's really done the trick, and we have seen a very strong momentum in our CASA growth.
On the MFI book, you have actually taken write-off of 171 crore rupees, while your cumulative provision is very high at 2.56% of advances. Do you think that the MFI book as a model is sustainable given the stress that we are actually seeing?
Yes, see, MFI is a product which does very well under normal circumstances, and when there is an external event risk, which like pandemic or whatever, when an external event risk happens, the MFI book goes under a pretty high level of stress. I mean, that's been the history of microfinance over the last 20 years in the country. I mean, we saw this a long time back, and that's why somewhere in 2011, we had decided that we will diversify. And so we started our used commercial vehicles, small business loan, etc. long time back. And today, if you see, microfinance contributes about 19% of the total advances, and 81% comes from secured loan books. But microfinance by nature is like that. You know, it's very difficult to kind of manage it in any different way. So we did see some stress in our microfinance book because of the pandemic last year. And so what we did is that we really kind of went through it and tried to figure out which areas, which customers have shown the highest probability of not paying back. And we took a prudent call to do a technical write-off in those accounts so that the book is cleaned up. I mean, the recovery efforts will still go on at the ground level. It's only a technical write-off. So the recovery efforts still continue at the field. But we thought prudent that we just kind of clean up the books by doing this write-off. And but this is something that's very standard in this industry. I mean, I have seen it myself 4 times now in the last 15 years. So I think it's more or less like a 3-4 year phenomenon.
All right, Mr. Vasudevan, we'll leave it at there. Thank you for joining us in ET Now and giving us your take on the performance of the company in Q4, also the impact of a second wave of COVID-19 on the way forward. That was N Vasudevan, who is the MD and CEO of Equitas Small Finance Bank. All right, on that note, we'll slip into a break on this edition of Market at Noon. But stay tuned, more on the other side. Don't go anywhere.